Yeah, thanks, Mark. So Jedi Options today, we're going to take a look at Netflix earnings, and we're going to look at a couple of potential trade ideas. So trades around Netflix earnings will be the topic. Normally, I would pop open a Word doc. I'd bring up my smooth draw. I'd draw us a few things, but I got to tell you, I'm fighting with one hand tied behind my back today. I know if I bring open my Blackboard and if I open up Word, I know my computer's gonna just quit. Okay, I'm getting a new computer next week, and I'm just trying to get this one not to blow up while I put it into the grave here. So a little more talking, a little bit less drawing and typing for me today, but I think you'll follow along okay. Take a look at Netflix. This is not unique. Every public company has earnings. We're in the middle of earnings season here. And so we thought it appropriate to think through how to analyze a stock going into earnings and a couple different ways you can play it, right? If you like earnings trades, there's a few different things you need to be aware of. First things first, the options market does a very good job of telling you what expectations are ahead of time. You don't have to go into earnings flying blind. There's a lot of very smart people wielding a lot of money that are making bets around earnings, that are driving the price of calls and puts, such that you can kind of know what's baked in. How much is Netflix expected to move? You go to the trade tab on Thinkorswim. You take a look at the top. You will see in yellow 3M's stands for market maker move, and then you'll see plus or minus a certain dollar amount. That essentially is the size of the move that's expected to happen after the earnings are released. And they try to isolate it to essentially the next 24 hours. So that's not the move that's priced in for the next 30 days or the next 1 year, but it's trying to, again, laser focus on how much is this going to move in the day after earnings. You can see for Netflix, it's about $29. You can convert that to a percentage by just dividing it into the stock price. So I got $29 divided by $322 stock. They're pricing in about a 9% move on earnings, which means if it moves 9%, really there's no profit there for somebody who is trading volatility. Okay, so let me take a step back. Going into earnings, you don't know if it's going to go up. You don't know if it's going to go down. It's a crapshoot. So most professionals are not swinging bullish or bearish short-term trades into earnings because there's no edge, right? What you see far more common is that people will trade volatility. They'll make a bet around the size of the gap. And so going back to the 9%, if that's what's baked in, if you bet the market's going to move more than that, and it only moves 9%, you're not going to make any money. If you bet that it's going to move less than that and it moves 9%, you're probably not going to make any money. So if tomorrow, at the end of the day, Netflix is up 9%, I say tomorrow, I can't remember when earnings are. I think it's the day after tomorrow. But if the day after earnings, it's up 9 or down 9%, it may seem like, oh, wow, it moved 9%. It blew out the doors. It's like, no, it really didn't. 9% is what was baked in. Okay. And so what you do if you want to trade volatility is you have to come up with an opinion. Do you have an opinion here? Do you think it's going to move more than 9%? If so, there may be some opportunity here. If you think it's going to move a lot less than 9%, there may be an opportunity here. And so those are the only two kind of opinions or stances that you can take if you're trading volatility. Either it moves less than is priced in, which means you think options are overpriced. You think they're too expensive. Or it moves more than is priced in, which means you thought options were too cheap. You were betting that it was going to move again outside of that range. Just one other side point: the $29 is actually what's considered a 1 standard deviation move, which statistically means that about 68% of the time it should move within that range. Technically, if it moves more than 9%, it doesn't mean the market was wrong per se. It's just that's the 1/3 of the time that it moves more than that 1 standard deviation range. Okay. But conceptually, do you think it's going to move more? Do you think it's going to move less? And that's going to influence which strategy you do. So which strategy might you do? Well, let's say that I think Netflix is going to be a snooze fest. I don't think it's going to move 29 bucks. I think it's going to move less. I can build a trade that wins, that makes me money, as long as Netflix doesn't move $29 up or $29 down. A couple of different ways you can do it, but the most popular strategy that you'll hear people talk about is an iron condor. Conceptually, if you look at the chart of Netflix, what we're going to do is we're going to sell an out of the money. You're going to sell some out of the money calls. You're going to do it through a spread. So it's an out of the money call spread. And then you're going to sell an out of the money put spread, essentially bracketing where you think the stock's going to be. And if it stays in the range, you're good. If it breaks out of the range, you're not good. So since it's a $29 expected move, I'm going to make sure my condor is wider than that expected move. Okay. Now, there's a whole nother conversation as to which time frame you use. I'm going to go ahead and just use a 30-day option, even though, earnings we're going to get resolution this week. I'm going to go a little further out in time. It makes it more conservative. But I will go to a 16-ish delta call option and a 16 delta put. And that creates what's known as a 1 standard deviation condor. So I'm going to go out and I'm going to sell the 275 put here. And you know what? I've already done it. So let me do this. Let me delete this guy. Take a look at this red order here. I built this pre-show. 275, 270 bull put, 385, 390 bear call. If you take a look, 275 is about a 16 delta. Okay, pretty far out of the money. And by the way, stock's at 322. Okay, so 322 minus 275. I'm 47 bucks below. All right. So not only would this have to drop more than $29, it's got to drop $47 or more to be outside of my profit range. They're giving me more room because I'm going out 30 days. Right? They're compensating me for the extra time that I'm exposed. And then on the top side, I did a 385, 390 bear call. And the stock's at 322. So I'm about 63 bucks on the top side. Okay. So if I draw those lines, 385, 275. It's actually a little bigger here, a little wider. 385, way up here. Okay, way up there. And then on the downside, I forgot what I said. It was 275. It was 275. All right, there you go. So what trade one? Trade one. You think Netflix isn't going to move that much? Selling out of the money bear call, selling out of the money bull put. That's your profit range. As long as she stays somewhat in that range for the next 30 days, you're good. Profit potential, by the way, you're getting $1.40 on a $5 spread, which is about a 30% return. Okay, looks good. Or you say, well, I don't think it's going to stay in that range, right? It's Netflix after all. I think it's going to do what it did in April. All right. I think this is going to blow the doors out. And it's either going to get destroyed or it's going to go up a lot. In which case, I don't want kind of this neutral range bound trade. I want to buy directional trade. I want to bet that it's going to move more than expected. So what you might do is just the inverse of what I did. See, an iron condor, there's somebody who sells that. There's somebody who buys that. And when you sell the condor, you get a credit. You're betting it's going to stay in the range. When you're on the opposite side of the transaction, and you're buying the condor, it's a debit trade, and you're the one who wants the stock to move a lot. And so if you do the inverse, we often refer to it as a debit condor or a debit con, because it sounds cool. And you're essentially betting we're going to move outside of the range. So what I did to make this a little more interesting, instead of just taking the same trade and flipping it on its head and buying it instead of selling it, I wanted to structure it a little bit different. So I actually went closer to today. I did Feb 3rd options, and I bought the 345, 350 bull call. So I came in closer, because the thing is, we're talking about a $30 move here. I don't want to build a debit condor where it's got to move up 60 points or down 70 points. I want to be a little bit closer to that market maker move. And so the idea was the stock's at 322. If I do a 345, 350 bull call, then I'm really just betting this is going to get above 345, towards 350, which it should if it moves more than $30, right? In fact, a $30 move takes it above 350. So I want to set up the debit condor where my max profit is if it moves more than $30 in one direction or the other. So 345, 350 bull call. If it gets above 350, right, jumps above there, that's my max profit zone. And then on the downside, same logic. Say, well, we're 322. So if the market's going to go down more than $30, it's going to be below 295. So let's set up a bear put down there, 300, 295 bear put. So if I look at the chart, I take the line here, move it up towards 300, 295. I just need Netflix to get above that 350 or get below that 295. And I make money. It's a bi-directional trade. I don't care which direction you go, Netflix, just make the big move. So final point here, when you look at the risk graph, the visual really helps cement this idea. When you look at the risk graph of the debit condor, you can see this kind of bi-directional nature, go up here a lot or go down here a lot. And it's just a condor flip the other way. And it's the opposite bet. It's the opposite bet. So you don't know ahead of time if it's going to move more or less than expected. But if you get in a situation where you do have a strong opinion, cool thing about the options market is you can bet on it. And in this case, you take your pick. You got Netflix, I think, tomorrow. Tomorrow after market. So typically you put these on before the close. You have to. You got till tomorrow at the close to jockey for positions. And then market closes, get your popcorn, you watch and see, hey, does it move more or less than expected? And do I win or lose?